Warren Buffett, the Oracle of Omaha, is a name synonymous with investment acumen and long-term value creation. His journey to becoming a Wall Street legend began in 1965 with the acquisition of Berkshire Hathaway, a struggling textile company. At the time, Berkshire Hathaway was a far cry from the conglomerate it would become. Buffett, however, saw an opportunity. He recognized the inherent value in the company's assets and its potential for generating cash flow. This marked the start of Buffett's unconventional approach to building an empire. Buffett's investment philosophy was and remains rooted in a deep understanding of businesses and their intrinsic value. Unlike many on Wall Street who chase short-term profits, Buffett focused on identifying companies with strong fundamentals and a durable competitive advantage. He believed in investing for the long haul, holding on to companies for years, even decades, allowing them to compound their earnings. This patient and disciplined approach set him apart from the often frenetic trading that characterized Wall Street. Buffett's investment strategy was also shaped by his aversion to risk. He famously remarked, "Rule number 1, never lose money. Rule number 2, never forget rule number 1. This cautious approach led him to favor businesses with a high degree of certainty and a wide margin of safety. He avoided companies with excessive debt, complex financial structures, or unpredictable earnings. This conservative approach may have seemed out of step with the go-go years of the 1980s and the tech boom of the 1990s, but it served him well over the long term, protecting his investors from major losses. Buffett's early success with Berkshire Hathaway laid the foundation for his future triumphs. It demonstrated his ability to identify undervalued assets, his commitment to long-term investing, and his unwavering focus on risk management. These principles would guide him through decades of market cycles, cementing his reputation as one of the greatest investors of all time. Warren Buffett's rise to prominence coincided with a period of significant change on Wall Street. The 1980s saw the rise of corporate raiders, hostile takeovers, and leveraged buyouts. This new breed of financiers, often armed with junk bonds and a thirst for quick profits, sought to unlock value by breaking up companies, selling off assets, or taking on significant debt. Buffett, with his long-term focus and aversion to financial engineering, became a vocal critic of these practices. He viewed them as short-sighted, destructive to businesses, and ultimately harmful to the economy. While Buffett was a staunch critic of Wall Street's excesses, he was not afraid to engage with the system when it aligned with his principles. A prime example is his involvement with Salomon Brothers in the late 1980s. Salomon, a major investment bank, faced a potential hostile takeover by corporate raider Ron Perlman. Buffett, seeing an opportunity to invest in a well-established business with a strong franchise, stepped in with a significant investment, effectively becoming a white squire and thwarting Perlman's takeover attempt. Buffett's involvement with Salomon was not without its challenges. In 1991, the firm was embroiled in a bond trading scandal that threatened its reputation and its very existence. Buffett, now chairman of Salomon, took swift and decisive action. He replaced key executives, cooperated fully with regulators, and publicly acknowledged the firm's wrongdoing. His actions, though costly in the short term, saved Salomon from collapse and reinforced his commitment to ethical business practices. His famous quote from that time, "Lose money for the firm, and I will understand. Lose a shred of reputation for the firm, and I will be ruthless," became a defining statement of his leadership. Buffett's willingness to challenge Wall Street's norms, both through his words and his actions, established him as a powerful voice for ethical and responsible investing. He demonstrated that long-term value creation and a commitment to integrity were not mutually exclusive, but rather essential ingredients for sustainable success. Throughout his career, Warren Buffett has consistently sought out companies with strong underlying fundamentals, regardless of short-term market fluctuations. This approach led him to make significant investments in companies like the Washington Post in 1973 and Capital Cities ABC in 1986. Both companies operated in industries facing disruption, but Buffett recognized their enduring value. He saw the Washington Post as more than just a newspaper. He viewed it as a trusted source of information with a deep connection to its community. Similarly, He recognized Capital Cities, ABC's strong management team, and its valuable broadcast licenses as assets that would withstand the test of time. Buffett's long-term vision and unwavering belief in the companies he invested in set him apart from many investors who were more focused on short-term gains. He was willing to be patient, allowing these companies to navigate industry challenges and emerge stronger. His investments in the Washington Post and Capital Cities ABC proved to be highly successful, demonstrating the power of his contrarian approach and his ability to identify value where others saw uncertainty. This long-term approach was again on display during the 2008 financial crisis. As markets plummeted and fear gripped Wall Street, Buffett remained calm and rational. He saw the crisis as an opportunity to invest in high-quality companies at deeply discounted prices. He provided much-needed capital to companies like Goldman Sachs and Bank of America, securing preferred stock with high dividends and warrants to purchase common stock. These investments, made at a time when many others were selling, generated substantial returns for Berkshire Hathaway and its shareholders. Buffett's actions during the financial crisis solidified his reputation as a shrewd investor and a steady hand in turbulent times. His willingness to invest when others were panicking, his focus on intrinsic value, and his unwavering belief in the resilience of the American economy proved to be a winning formula. Warren Buffett has often emphasized the importance of float in his investment strategy. You see, float refers to the pool of money that insurance companies hold between the time they collect premiums and when they have to pay out claims. This money can be invested, generating returns for the company. It's like having access to a large sum of money to invest without actually owning it. Buffett's genius lies in using this float to acquire more businesses and generate even more income. His long-term vision allows him to see opportunities where others might not. By focusing on the long term rather than short-term gains, Buffett has built an empire that stands the test of time. As we look to the future, Warren Buffett's influence on Wall Street is undeniable. His principles of value investing, patience, and long-term vision have reshaped how many approach investing. Even in a rapidly changing financial landscape, Buffett's strategies remain relevant. Young investors and seasoned professionals alike continue to study his methods, hoping to capture a fraction of his success. The Oracle of Omaha has not only shaped the past and present of Wall Street, but is also paving the way for its future.